Hello everyone. Today we are going to start our candlestick pattern series. First we will be starting with bullish candlestick patterns, then bearish, and then continuation pattern. The first in this is hammer pattern. This is a bullish pattern type. Means if this pattern has been seen forming, that means the market may go upwards from this point. This is a reversal pattern, means when the market is falling or in downtrend and bullish hammer candlestick is formed, then we can say that the downtrend may end and now the market will move upward from this point. So, as written here, the hammer is a bullish reversal pattern that forms after a downtrend. It is characterized by a small body near the top of the candlestick with a long lower wick. This indicates that despite selling pressure driving the price down, buyers stepped in to push the price back up. The implication is that the downtrend may be nearing its end, and a potential uptrend could follow. This is how this looks, a long wick and with small candlestick body. So let's view a real example to understand more effectively how this can be identified. Here you can see the market was in downtrend, and then a hammer pattern is observed here, with the next candlestick going up that confirms the market trend has changed and is now in bullish mode, and you can see the market from this point has gone upwards. So the next up in bullish signal pattern is inverted hammer pattern. Looks same as hammer pattern, but inverted, that is. In this, the wick is upward and the candlestick body is below the wick. As written, the inverted hammer is a bullish reversal pattern that appears after a downtrend. It has a small body, a long upper wick, and little to no lower wick. This indicates that buyers attempted to push the price higher but met resistance. The following bullish candlestick confirms the reversal. So, let's understand with a real example. So, as you can see, there's inverted hammer pattern shown, which indicates that the buyers are there, but the sellers stopped. But that's an indication also that the market might go up from here, and there you can see that also, that market has gone up. So moving forward, let's talk about the piercing line pattern. This is also a very powerful bullish pattern. And what makes this one interesting is that it's a two candlestick formation. So you need to look for two candles together to identify this pattern. As written, the piercing line pattern is a two candlestick formation signaling a potential bullish reversal. It occurs in a downtrend, with the first candlestick being bearish and followed by a bullish candlestick that opens lower but closes above the midpoint of the previous candlestick. This pattern suggests a strong shift in market sentiment from bearish to bullish. Now let me explain how this works. Imagine the market is in a downtrend, prices are falling, and then you see a big bearish red candlestick forming first. Everyone is thinking, oh, the market is going down more. But then the next day comes, and it opens even lower than the previous close, making everyone more scared. But here's the interesting part. By the end of that day, the buyers come in with full force, and the price closes way up, actually going above the midpoint of that previous red candlestick. This is a very strong signal because it shows that despite the initial selling pressure, the buyers are now taking control. The piercing line pattern suggests a strong shift in market sentiment from bearish to bullish. So whenever you see a bearish candle followed by a bullish candle that opens lower but closes above the midpoint of the previous candle, you know the piercing line pattern has formed, and the market is likely to reverse upwards from here. The key point to remember is the second candle must close above 50% of the first red candle's body. If it closes below the midpoint, then it's not a piercing line pattern. This pattern is quite reliable when you see it at the bottom of a downtrend, because it clearly shows that sellers are losing power and buyers are stepping in. Here you can see a big red candlestick was formed, and then a green candle with covering more than 50% of the previous one, which forms a piercing line pattern. And as you can see, the market has gone upwards from there. Now moving up to the next, and one of the most popular and powerful patterns, the bullish engulfing pattern. This is a very strong reversal signal that traders love to see. So what is this pattern? It's again a two candlestick formation, but this one is really dramatic. As written, the bullish engulfing pattern is a reversal signal. It consists of a small bearish candlestick followed by a larger bullish candlestick that completely engulfs the previous one. This indicates that buyers have taken control, overpowering the sellers, and suggests a potential upward movement. Here's how it works. The market is falling in a downtrend, and you see a small bearish red candlestick forming. Nothing special so far, right? But then comes the next day, and boom, a big green bullish candlestick forms that completely engulfs or covers the entire body of that previous red candlestick. This means the green candle's body is so big that it swallows up the previous red candle completely, from top to bottom. As you can see here, the bullish engulfing pattern was formed, and the market has gone up from that point. Now, why is this so powerful? Because it shows that buyers have taken complete control. They didn't just push the price up a little bit. They completely overpowered the sellers. The bullish engulfing pattern indicates that buyers have taken control, overpowering the sellers, and suggests a potential upward movement. So whenever you see a small red candle followed by a large green candle that completely covers it, you know that a bullish engulfing pattern forming. This is one of the most reliable reversal patterns, especially when it forms after a long downtrend, because it shows a complete shift in market power from sellers to buyers. Many professional traders wait specifically for this pattern before entering a trade, because the success rate is quite high when combined with other indicators like volume. Remember, the bigger the engulfing candle, the stronger the signal. A small engulfing might not be as powerful as a large one. All right, now let's talk about a slightly different pattern, the bullish spinning top. This one is interesting because it shows something unique, market indecision. So what does this pattern look like? It has a small body in the middle and long wicks on both the top and bottom sides. It almost looks like a spinning top toy. That's why it's called spinning top. As written, a bullish spinning top is characterized by a small body and long wicks on both sides. It indicates indecision in the market, with both buyers and sellers unable to gain the upper hand. When it appears after a downtrend, it suggests that selling pressure is weakening and that a bullish reversal may be imminent. Now here's what's happening in the market when this forms. Both buyers and sellers are fighting. Sellers push the price down, creating the lower wick, but then buyers push it back up. Then buyers try to push it higher, creating the upper wick, but sellers bring it back down. So the candle ends up with a small body and long shadows on both sides, showing that neither buyers nor sellers could win. Think of it like this. In a downtrend, sellers are in control, but when a spinning top forms, it means sellers can't push the price down anymore. There's resistance from buyers, and this indecision often leads to a reversal. So when you spot a spinning top at the bottom of a downtrend with long wicks on both sides and a small body, start watching carefully because the market might be about to turn bullish. The confirmation usually comes with the next candlestick. If it's a strong bullish candle, then you know the reversal is happening. As you can see here, also the market has gone up. Now we're going to learn about a really beautiful pattern called the morning star. This is called morning star because just like a morning star appears before sunrise, this pattern appears before the market rises. This is a 3-candlestick pattern, so you need to look at 3 candles together to identify it. Let me explain step by step how this forms. First, the market is in a downtrend and you see a long bearish red candlestick. Everyone is selling, prices are falling. Then comes the second candle. This is the star. It's a small body candlestick that gaps down, meaning it opens lower than the previous close with a gap. This small candle could be red or green, doesn't matter. The important thing is it's small and shows indecision. And then comes the third candle, a long bullish green candlestick that closes near or above the midpoint of the first red candlestick. The morning star pattern is characterized by a long bearish candlestick first, followed by a small body candlestick that gaps down, and ending with a long bullish candlestick that closes near the midpoint of the first candlestick. This pattern indicates a shift from selling to buying pressure. It's like the market is saying, okay, sellers had their time, now it's buyers' turn. The middle candle, the star, is the turning point. It shows that sellers are exhausted. They can't push the price down much anymore. And then buyers come in with force, creating that third green candle. This is one of the most reliable reversal patterns in candlestick analysis, especially when it forms at a strong support level. The success rate increases even more when you see high volume on that third green candle. So always watch for this 3-candle formation at the bottom of downtrends. Let's talk about a very powerful bullish continuation pattern, 3 white soldiers. This name itself sounds strong, right? Like soldiers marching forward. And that's exactly what this pattern represents, a strong bullish march upwards. So what does this pattern look like? It consists of 3 consecutive long green candlesticks. All 3 are bullish, all 3 are strong. Now here's the key characteristics you need to look for. Each candlestick should open within the previous candle's body and close at or near its high. Also, the wicks should be small or almost no wicks. The 3 white soldiers pattern consists of 3 consecutive long bullish candlesticks with small or no wicks. Each candlestick opens within the previous body and closes at or near its high. What does this tell us about the market? It indicates very strong buying pressure. Buyers are in complete control for 3 sessions straight. There's no hesitation, no pullback, just continuous buying. This pattern often appears after a downtrend or consolidation period and signals the potential start of a sustained uptrend. It's like the bulls have formed an army and are ready to push the prices higher. When you see this pattern forming, it's a very strong signal. It shows that buyers are dominating the market, and the momentum is likely to continue upwards. However, there's one thing to watch out for. If the third soldier becomes very long with a huge upper wick, it might indicate that the rally is getting exhausted. But if all three soldiers are strong and steady, it's a great bullish signal. Professional traders often look for this pattern after a period of consolidation or at the breakout of a resistance level, because that's when it's most effective. The combination of pattern plus breakout gives a very high probability trade setup. So keep your eyes open for 3 consecutive green soldiers marching upwards. Now let's understand the 3 inside up pattern. This is another 3 candlestick formation, but with a different structure. The name, inside up, gives you a hint about how it looks. Let me explain how this pattern develops. First, the market is in a downtrend, and you see a long bearish red candlestick forming. This shows sellers are in control. Then comes the second candle, and this is important. It's a smaller bullish green candlestick that forms completely within the body of that first red candle. That's why it's called inside, because it's inside the previous candle's body. This second candle shows that buyers are starting to come in, but they're still cautious, not very aggressive yet. And then comes the third candlestick, a strong bullish green candle that closes above the high of the first red candlestick. This confirms that buyers have taken control. The 3 inside up pattern is a bullish reversal signal formed by 3 candlesticks. The first is a long bearish candlestick, followed by a smaller bullish candlestick that forms within the first one's body, and a third bullish candlestick that closes above the first one's high. This indicates a clear shift in momentum from bearish to bullish. It's like a gradual takeover by the bulls. First candle, sellers dominate. Second candle, buyers start entering but cautiously. Third candle, buyers take full control. This pattern is very reliable because it shows a step-by-step change in market sentiment. It's not a sudden reversal. It's a calculated shift. When you spot this pattern at the end of a downtrend or at a support level, it's a strong signal to consider going long. Many traders wait for the close of the third candle before entering a trade, because that's when the pattern is confirmed. Let's discuss the Bullish Harami pattern now. Harami is a Japanese word that means pregnant, and when you see this pattern, you'll understand why it's called that. This is a 2 candlestick pattern, and it looks like one candle is inside another, like a baby inside the mother, as you can see here. Here's how it forms. The market is in a downtrend, and you see a large bearish red candlestick first. This shows strong selling pressure. Everyone is bearish. Then comes the second candle, a small bullish green candlestick that forms completely within the body of that previous large red candle. The entire body of this small green candle is contained within the red candle's body. It looks like the big red candle is pregnant with the small green candle inside it, as written. The Bullish Harami is a 2 candlestick pattern indicating a potential reversal. It occurs when a small bullish candlestick forms within the body of a preceding large bearish candlestick. So what does this tell us? It suggests that selling pressure is weakening. The sellers who were dominating before can't push the price down anymore, and buyers are starting to gain control, though slowly. The small green candle shows that the market is finding support. It's not going down much anymore, and this could be the beginning of a reversal. Now, the Bullish Harami itself is a warning signal. It says, hey, the downtrend might be ending, but for confirmation, traders usually wait for the next candlestick. If the next candle is a strong bullish candle, then the reversal is confirmed. This pattern works best when it appears at a strong support level or after an extended downtrend, because that's when sellers are most exhausted and buyers are ready to step in. One thing to remember, the smaller the second candle and the larger the first candle, the more powerful the signal, because it shows a dramatic reduction in selling pressure. Now we're going to learn about a very interesting pattern called tweezer bottom. The name comes from the fact that it looks like a pair of tweezers. This is a 2 candlestick pattern, and a special thing about it is that both candles have matching lows, meaning they touch the same bottom price level. Let me explain how this works. The market is in a downtrend falling down. Then you see a candlestick that makes a low. The next candlestick also comes down and tests the exact same low level. Both candles have almost identical lows. The first candle can be red or green, and the second candle is usually the opposite color. But the key point is, both candles touch the same low price and then bounce back up. A tweezer bottom is a bullish reversal pattern formed by 2 candlesticks with matching lows. It indicates that the downtrend has found a strong support level, and a potential reversal to the upside could follow. So what's happening here? The market tried to go below a certain price level twice, but both times buyers defended that level. They didn't let the price go lower. This shows that there's strong support at that level. Sellers try to push down, but failed twice. And when sellers fail repeatedly at the same level, it often leads to a reversal. Think of it like this. Imagine someone trying to break through a door twice and failing both times. After the second failure, they give up. Similarly, sellers give up after failing to break the support twice. The tweezer bottom is most effective when it forms at a significant support level or at the end of a long downtrend. The matching lows show clear rejection of lower prices. For confirmation, traders look at the candle that follows the tweezer pattern. If it's a strong bullish candle, then the reversal is confirmed and traders can consider entering long positions. This pattern is quite reliable, especially when combined with volume analysis. If you see high volume at those matching lows, it shows strong buying interest at that support level. Let's talk about the bullish counterattack pattern now. The name itself sounds aggressive, right? And that's exactly what this pattern shows, bulls counterattacking the bears. This is a two-candlestick pattern, and it demonstrates a dramatic shift in market sentiment. Here's how it forms. First, you see a bearish red candlestick in a downtrend. Sellers are in control. Everything looks bearish. Then the next day opens even lower, creating a gap down. At this point, most traders think the downtrend will continue and the price will fall even more. But here comes the surprise. Instead of continuing down, the price reverses during the session. And by the end of the day, it closes at the exact same level as the previous candlestick's close. The bullish counterattack pattern consists of a bearish candlestick followed by a bullish candlestick that opens lower but closes at the same level as the previous candlestick's close. This is called a counterattack because the bulls completely reversed the initial bearish sentiment. Despite opening lower, they pushed the price all the way back up to erase the previous loss. What does this tell us? It indicates that buyers have countered the selling pressure very strongly. Even though the day started badly with a gap down, buyers were powerful enough to bring it back. This sudden and strong reversal potentially leads to a trend change because it shows that sellers are losing control and buyers are becoming aggressive. The key characteristic to look for is that both candles must close at approximately the same price level. If there's a big difference in the closing prices, then it's not a counterattack pattern. This pattern is most effective when it appears after an extended downtrend or at a significant support level, because that's when the counterattack by bulls is most meaningful. Traders often wait for the next candlestick to confirm the reversal. If the next candle is also bullish, it confirms that the counterattack was successful and the uptrend has begun. Volume is also important here. Higher volume on the second candle shows stronger buying pressure. Now let's learn about one of the strongest reversal patterns, the bullish kicker. This is called kicker because it literally kicks the trend in the opposite direction. This is a very powerful two-candlestick pattern, and when you see this, you know something dramatic is happening in the market. Here's the structure. First, you have a bearish red candlestick in a downtrend. Nothing unusual, just normal selling. But then comes the second day, and this is where the magic happens. The market opens with a big gap up, meaning it opens much higher than the previous day's close. And it doesn't stop there. The entire day continues to be bullish, forming a strong green candlestick that moves even higher. The bullish kicker pattern is a strong reversal signal. It starts with a bearish candlestick followed by a bullish candlestick that opens above the previous close with a gap and continues to move higher. This shows a dramatic and sudden shift in market sentiment from bearish to bullish. It's like the market sentiment has completely flipped overnight. What causes such a dramatic move? Usually it happens due to some major positive news or event that changes the entire perspective of traders. Maybe a company announces great earnings, or there's positive economic news. The gap up itself shows that buyers are so aggressive that they don't even want to trade at the previous day's prices. They're willing to pay much higher prices right from the opening. The bullish kicker is one of the most reliable reversal patterns because it shows extreme buying pressure. The bigger the gap, the stronger the signal. When you spot this pattern, it usually leads to a strong uptrend because the market psychology has completely changed. Bears are in panic mode. Bulls are celebrating. However, one thing to watch for is sometimes the gap gets filled later, so it's good to wait for a confirmation candle or use proper stop losses. Let's discuss a rare but very powerful pattern, the bullish abandoned baby. This is called abandoned baby because the middle candle is literally abandoned, isolated with gaps on both sides. This is a three-candlestick pattern, and it's quite rare to find, but when it appears, it's a very strong signal. Let me explain the structure. First, you have a long bearish red candlestick in a downtrend. Sellers are dominating, prices are falling. Then comes the second candle, and this is the baby. It's a doji candle, which means it has almost no body, showing complete indecision. And here's the important part. This doji gaps down from the previous candle. There's a clear gap between the first candle's low and the doji. Then comes the third candle, a long bullish green candlestick that gaps up from the doji. Again, there's a clear gap between the doji and this third candle. The bullish abandoned baby is a rare 3-candlestick pattern indicating a reversal. It consists of a long bearish candlestick, a doji that gaps down, and a long bullish candlestick that gaps up. So the doji is completely isolated, abandoned in the middle with gaps on both sides. That's why it's called abandoned baby. This pattern suggests a very strong shift in market sentiment from bearish to bullish. The doji in the middle represents the turning point. It's the moment of maximum uncertainty. The gaps on both sides show dramatic changes in sentiment. First, extreme bearishness creating the gap down, then extreme bullishness creating the gap up. This pattern is powerful because it shows a complete psychological reversal in the market, from strong selling to confusion to strong buying. When you spot this rare pattern at the bottom of a downtrend, it's a very reliable signal for a trend reversal. Many professional traders specifically watch for this pattern because of its high success rate. The key things to confirm: clear gaps on both sides of the doji and strong candles before and after the doji. If these conditions are met, you've found a bullish abandoned baby. Now let's learn about the morning star doji pattern. This is very similar to the morning star pattern we learned earlier, but with one important difference. The middle candle is a doji. This is also a 3-candlestick pattern, and it's considered even more powerful than the regular morning star. Let me explain how it forms. First, the market is in a downtrend, and you see a long bearish red candlestick. Everyone is selling. Sentiment is very negative. Then comes the second candle, the doji. A doji is almost no body, just a tiny body with wicks. This doji gaps down for the previous candle, meaning it opens lower with a gap. The doji represents complete indecision in the market. Neither buyers nor sellers are in control. The market is confused, don't know which direction to go. Then comes the third candle, a long bullish green candlestick that closes near or above the midpoint of the first red candlestick. This confirms the reversal. The Morningstar doji is similar to the Morningstar pattern, but features a doji as the middle candlestick. The doji indicates indecision in the market, and the following bullish candlestick confirms the reversal. This pattern signals a shift from selling to buying pressure. But because the middle candle is a doji, it shows even more uncertainty, which makes the subsequent reversal more powerful. Think about it. When there's complete confusion shown by the doji, and then suddenly a strong bullish candle appears, it means buyers have decisively taken control after a period of doubt. This pattern is more reliable than the regular Morningstar, because the doji shows a clearer turning point. It's like the market has completely stopped, paused, and then decided to go up. When you see this pattern forming at a support level or after a long downtrend, it's a high probability reversal signal. Traders often wait for the close of the third candle to confirm the pattern before entering trades. Finally, let's talk about a beautiful pattern called the dragonfly doji. The name dragonfly comes from how it looks like a dragonfly with wings. This is a single candlestick pattern, and it's very powerful when it appears at the right place. So what does a dragonfly doji look like? It has a very small body at the top. Almost no body actually. The opening and closing prices are almost the same. But here's the distinctive feature. It has a very long lower wick and little to no upper wick. It literally looks like a T shape, or like a dragonfly with its body at the top and a long tail below. A dragonfly doji is a bullish reversal pattern that appears at the bottom of a downtrend. It has a small body at the top with a long lower wick, indicating that despite selling pressure, buyers push the price up significantly during the session. Let me explain what's happening in the market when this forms. The session starts, and sellers immediately push the price way down, creating that long lower wick. At that moment, it looks like the downtrend is continuing. But then the buyers step in with force. They push the price all the way back up. And by the end of the session, the price closes near the opening price. That's why the body is so small. This shows tremendous buying pressure. Even though sellers tried hard to push the price down, buyers completely reversed it. This is a strong signal that buyers are taking control. The dragonfly doji suggests that the downtrend may be nearing its end. It's like a line in the sand where buyers said, "No more. We're not letting the price go lower." When you see this pattern at the bottom of a downtrend or at a strong support level, it's a very reliable reversal signal. The longer the lower wick, the stronger the signal, because it shows more aggressive buying. For confirmation, traders look at the next candlestick. If it's a strong bullish green candle, that confirms the reversal is happening. Many traders also check the volume. If there's high volume on the dragonfly doji, it means strong buying interest. One important point to remember: The dragonfly doji only works as a bullish reversal when it appears after a downtrend. If it appears in an uptrend, it doesn't have the same meaning. So whenever you see that T-shaped candle with a long lower tail at the bottom of a falling market, you know that's a dragonfly doji telling you that buyers are stepping in and a reversal might be coming. Now let's learn about an extremely rare pattern, the bullish TRI star. This is one of the rarest candlestick patterns you will ever see, but when it appears, it's a very powerful signal. The name Tri-star means 3 stars, and that's exactly what this pattern consists of, 3 doji candles in a row. Now imagine seeing 3 dojis in a row. That's the tri-star pattern. Here's the structure for a bullish tri-star. All 3 candles are dojis. The first doji appears in a downtrend. Then the second doji forms at the lowest point. It's like the bottom of the pattern. And then the third doji forms slightly higher. The bullish tri-star is a rare candlestick pattern that signals a potential reversal from a downtrend to an uptrend. It consists of 3 doji candles in a row, with the middle doji forming at the lowest point of the pattern. This formation indicates that the market is experiencing extreme indecision after a period of selling pressure. 3 consecutive dojis means 3 sessions of complete uncertainty. When this appears at the bottom of a downtrend, it suggests that the selling pressure may be completely exhausted. Sellers have no more power left, and buyers could start to take control. Think about it. If the market can't decide direction for 3 consecutive sessions, it means the previous trend has completely lost momentum. And after such indecision at the bottom, an upward reversal is likely. This pattern often points to a new uptrend beginning. The market has essentially reset itself after the triple doji formation. For confirmation, traders watch for a strong bullish candle after the tri-star. If the next candle is a long green candle with good volume, it confirms the reversal. Because this pattern is so rare, when you do spot it, pay very close attention. It's like finding a gem. Professional traders know that the tri-star has a very high success rate when it appears in the right context. Let's discuss a very clever pattern called the bullish hickake. The word hickake is Japanese and means to trap or trick, and that's exactly what this pattern does. It traps the sellers. This is a bit more complex pattern, but once you understand it, you'll recognize it easily. The bullish hickake typically emerges in a bearish market or downtrend. Here's how it develops. First, you see an inside bar. What's an inside bar? It's a candle whose entire range is contained within the previous candle's range. This inside bar shows consolidation or indecision in the market. The market is taking a pause. Then comes the tricky part. The next candle breaks out, but in the wrong direction, meaning it breaks downward, making traders think the downtrend will continue. Sellers get excited. They think the market is going lower, so they sell more. But here's the trap. The market quickly reverses. Instead of continuing down, it shoots back up, creating a strong bullish move. All those sellers who entered positions get trapped. The bullish hickake is a bullish reversal pattern that often emerges in a bearish market or downtrend. It starts with an inside bar showing consolidation. Then the subsequent candle breaks out in the opposite direction, creating a false move that traps sellers. But the market quickly reverses with a strong bullish move. This pattern is valuable for traders because it catches the trapped sellers. When they realize they're wrong, they have to buy back their positions, which pushes the price even higher. The hickake pattern shows that the market tested one direction, found no follow-through there, and then reversed strongly in the opposite direction. For best results, look for this pattern near key support levels or at the end of a downtrend. When it occurs there with increasing volume, the reversal signal is very strong. The confirmation comes when you see that strong bullish move after the fake breakout. If volume increases on that bullish move, it's even better. This pattern teaches an important lesson about false breakouts. Not every breakout is real. Sometimes the market tricks traders, and that creates excellent opportunities for those who know what to look for. Now we're going to learn about a very rare and complex pattern, the concealing baby swallow. This is one of the most unusual patterns you'll come across, but it's quite reliable when it appears. This is a 4-candlestick pattern. Yes, for candles, and all of them are bearish, which makes it interesting. Let me walk you through it step by step. The market is in a downtrend. First, you see a long bearish red candlestick. Strong selling, nothing unusual. Then comes the second candle. Also a long bearish red candlestick. The downtrend continues. Sellers are still in control. Now comes the third candle. This is where it gets interesting. It's also a bearish candle, but it's smaller and may have a gap down. And then comes the fourth candle, the key candle. This fourth bearish candle is large, and it completely engulfs the third candle. The fourth candle opens lower and closes higher than the third candle, swallowing it completely. The concealing baby swallow is a rare pattern that forms during a downtrend. It consists of 4 candles, all bearish. The first 2 are long bearish candles, followed by a third bearish candle that is completely engulfed by the 4th bearish candle. The final candle opens lower and closes higher, indicating that the bearish momentum has weakened. So what's happening here? Even though all 4 candles are bearish, the pattern shows that selling pressure is getting exhausted. The fact that the 4th candle engulfs the 3rd one shows that sellers are running out of steam. The pattern suggests that sellers tried to push the market lower 4 times, but by the 4th attempt, they couldn't push it as low as before. This indicates selling exhaustion and the possibility of a new upward move. Traders interpret this pattern as a sign that the downtrend is ending. When you see 4 bearish candles, but the last one shows weakness by engulfing the previous one, it means a reversal might be on the horizon. This pattern is quite rare, so when you spot it at the bottom of a significant downtrend, pay close attention. It's a critical signal for those looking to catch a reversal. The confirmation comes with the next candlestick. If you see a strong bullish green candle after this 4-candle pattern, that confirms the reversal, and you can consider entering a long position. The concealing baby swallow teaches us that sometimes exhaustion shows up in subtle ways. It's not always a dramatic reversal pattern. Sometimes the market just runs out of sellers, and that's when the turnaround happens. Let's talk about a very special and rare pattern, the unique 3 rivers. This pattern is not very common, but when it appears, it's a reliable bullish reversal signal. This is a 3-candlestick pattern, and the name 3 rivers comes from the 3 different flows of momentum it shows. Here's how it develops. First candle is a long bearish red candlestick, showing strong selling pressure. The downtrend is in full force. Sellers are dominating. Then comes the second candle, and this is interesting. It's also a bearish candle, but here's the key. It has a very long lower shadow or wick. This long lower wick shows that even though the candle closed bearish, buyers tried to push the price up during the session. So you can see there's some buying pressure coming in. Sellers pushed down, but buyers defended and pushed back up, creating that long lower shadow. Then comes the third candle, a small candle. It could be slightly bullish or neutral. The important thing is it's small, showing indecision in the market. The unique 3 rivers pattern is a bullish reversal signal that forms after a downtrend. It consists of 3 candles. First is a long bearish candle, followed by a second candle with a long lower shadow reflecting buying pressure. And the third candle is a small bullish or neutral candle, showing indecision. This pattern suggests that the downward momentum is weakening, and buyers are starting to step in. The first candle shows sellers in control. The second candle shows buyers are fighting back. And the third candle shows the fight is balanced. When these 3 conditions come together, it indicates that the downtrend may be nearing its end. Sellers are losing their power. Buyers are gaining confidence. For confirmation, traders wait for the next candle after this pattern. If it's a strong bullish candle, then the reversal is confirmed. This pattern is most effective when it forms at a significant support level. This completes our bullish candlestick pattern series. I hope you understood all these patterns clearly. Remember, these patterns work best when combined with other technical indicators and proper risk management. To learn more about trading and investing concepts, please visit our platform, The Coder's Trade. Don't forget to like, share, and subscribe. And let me know in the comments if you want me to explain anything in more detail. Thank you so much for